Okay, so we're about to go live here. Let me go ahead and take this down for now. All right, we are live now. Good, good. All right, we're now live on YouTube and we are live on LinkedIn. Let me check and make sure we are live on Instagram. Apologies for not, I have to do this in a manner that I know. All right, let me make sure that we are live on TikTok, and it looks like we are. Okay, so we are now live, everybody, and what I want to talk about today is it stems from something that happened earlier this morning. I have people reach out to me all the time. Sometimes people are looking for my opinion on the market or my opinion on the economy, various things people reach out to me for, and a lot of times people reach out to me for partnerships. They'll reach out to me to do some sort of affiliate program. And this morning I had a call with someone who was, you could tell that he was new in business and he was a young guy. And I found out during the conversation that it just so happened that he was 16 years old and he was starting an AI company, and that company was going to be based around picking stocks. And he was explaining to me how he was picking stocks, and effectively what he was doing was a sorting and filtering service that would pick stocks that were doing really well based on certain criteria he put in, doing well in the market now. Now, what does that mean when you say that you're doing well in the market now? Well, it means a couple of things. Sorting services, and I don't know if AI is actually taking it further than this, but from the conversation that I had with him, it didn't feel like it really had gotten much further than what we've always had, which is like, what stocks are breaking out? What stocks are breaking out on high volume? What stocks are breaking out on high volume and prices going up X percentage? These are sorting mechanisms that you can utilize when you're trying to look up stocks. And he's trying to build a company around it. And what I had told him and what automatically came to my mind is that the thing with investing, the thing with the stock market, the bond market, commodity market, metal market, any markets, is that they are run by people, and people's emotions impact markets far more than any fundamental analysis is ever going to show you, and far more than any filtering program can ever give you. And this is what I mean by that. So imagine that if you have this stock and it's breaking out and it's doing fantastic and it's going to new highs, and all of the sudden news comes out about a new conflict. So conflict about what's going on now, perhaps with Israel. And all of a sudden people's emotions become fearful. That can turn on a dime. Okay. So the market can roll over on a dime. The trend can change on a dime. And the next thing you know, you're investing in a market that no longer exists. And what happens a lot with these signaling services and these timing services and these trend services is that as the trend changes, as something changes, they don't catch up. They don't keep up. You give back most of your gains. That's what happens in these services. And so real quick, I'm going to plug myself. As you see down below there, I have the Promethean VIP mentorship program starting in a couple of weeks. Effectively, what I have is a system. I am a 25-year veteran. I was a wealth planner and manager and a financial advisor for almost 2 decades. And I've created a system now which starts with education. It basically just teaches you what it is that I do and how I do it. The next step that you do is you subscribe to my newsletter. Receiving my newsletter will show you this is what markets are doing now. This is what economies are doing now. This is what the trend is doing now. And what we're going to do with that is we're going to identify when that's going to change, and we're going to be able to manage risk, right? So we're going to manage the risk inside the portfolio. And the third piece of that is that you, based off of my information and probably some information from a financial advisor that you're working with now, or maybe you work with yourself and you're self-directed, you're going to then go and you're going to place those trades. You're going to make the decisions and you're going to make adjustments in your portfolio. So we're going to educate you, build a disciplined process for yourself, build a disciplined money management system for yourself, build a disciplined investment approach, then you're going to receive my newsletter, which comes out a couple times a week. And when you get that newsletter, you can then make unbiased decisions on your own investments and on what you're doing, so that you're not just following, again, you're not ending up in this signaling service type situation, or with the financial advisor who, and there's nothing wrong with it, they work off of asset allocation. So they are building a program with you that's built off of, hey, in 30 years, if you have an asset allocation like this, you should end up here. But what a lot of people are looking for is they're looking for something in addition to that. What they're looking for is something that is going to add to that. They want to be a little more active. They don't simply want to have an asset allocation model. They want to actively try to manage the risk of upcoming bear markets. And that's what I help you do, is develop a system to do that. And the first piece of that system is right below my VIP mentorship program, basically, because everything starts with education. If you don't have a disciplined and structured investment portfolio and cash management and risk management, if you don't have those three things, cash management, risk management, and investment management, if you don't have those set up in a structured, disciplined approach, you will fail. I help you set that up. And from there, you receive the information. The newsletter comes out. It's usually in a video format as well, for those of you that aren't that interested in reading. That will then help you guide your investments. Okay. So back to the conversation that we were having earlier, which was about the young man who had the signaling service and the AI service. I never want to be the guy to tell someone that is out there promoting their new business or trying to get a business off the ground that it's a bad idea. I never want to do that, right? So I didn't say that to him. I simply explained to him that his signaling service, which was also somewhat of a filtering service, to be quite honest, it was filtering through stocks. While it is amazing that there's no risk management involved, there's no way to identify any areas of risk that are coming up. And risk is one of the things in investing or in life or in starting a business that you have to be aware of and you have to make adjustments for, right? So as a new risk shows itself or presents itself, you then make an adjustment for that risk. And the reason that I focus on the emotional risks inherent in a stock market is because those are the risks that most times will make the biggest difference. Okay. When the market is in the ebbs and flows, when the structure of the market, which the structure of the market is ups and downs, when the structure of the market's ups and downs are kind of flowing in a natural manner, that's not really something I tell anyone to be incredibly active in trying to get out of the way, or warning that I will let you know that, hey, what we see here is a warning that we have a correction coming. And here's how we know we have a correction coming. Here's how we see the correction coming. So I'll identify that footprint in the market. I'll identify for you how that's happening. And by the way, you'll also be quite aware of how that's happening because you will have taken the VIP mentorship course. This will not be new to you, right? And I don't want to use the term course. I use very loosely. This is a system. This is a system that gets you from the beginning of your investment process to setting up your money management process, your risk management process, and then your investment discipline, to then identifying points of inflection in the market, so that when you're receiving my newsletter, you're able to adjust your investment portfolio based on your own setup, based on your own knowledge, or the knowledge you have, or the strategy that you're utilizing with your investment advisor, your financial advisor, your wealth advisor. So back to the emotions. So why is the emotional footprint? Why is the emotional shift in us, in people that are involved in the market, so important? I'll tell you why. Because everybody gets caught up in the day-to-day movements of the stock market, and there's a place for that. There are guys out there that are day trading, that want to know what the movements are at any given time, and pretty consistently. So they want to know on a daily basis, and they're really working off of 1-minute charts and 5-minute charts. And that's great. And there's definitely a place for that. But for the average person, for the average investor, what they're looking for is the big moves. They're looking for like the down markets that started in 2021, right? They're looking for the moves that come down 10, 15, 20%. And Warren Buffett is very synonymous for having the same opinion as myself, which is you don't need to be right every day in the stock market, right? I mean, most of the times you're going to either make or save money is once or twice a year, okay? And if you're going for the really big bear markets, which occur about 20% of the time, so once in every 4 years. So one time in every 1 year in every 4 years, we experience a bear market, and that's historical data. If you're trying to avoid that, that means that really 80% of the time, there's no risk management. You are a buyer of the markets. Hopefully, you have some sort of a system where you're buying the strength and at least identifying the weakness and staying away from that. Something I hear quite a bit is, well, I'm set. I invest for the long term. I don't care. And I always point out to people that it does matter because I'm sure everyone, all of you out there own some international percentage in your investment portfolio. And if you do, then you know that China is down 70% in the last 20 years. That's a long-term hold, right? And that's a pretty big country with a pretty big economy. And can you imagine what that would have done to your portfolio if you had been rebalancing into China over the last 20 years? So that long-term basis is great, but remember, you want to identify strength and weakness in the market. And that's one thing that I do on a weekly basis is just keep you up to date on where strength lies, where weakness lies, and maybe what you can do about that strength and that weakness. Like what positions you can change so that you're not buying into weakness and selling out of strength. We want to own strength and we want to sell weakness. This is a way that you are basically have a portfolio that is consistently hedged against risk. When I say hedged against risk, you're minimizing the risk to your portfolio. And you're minimizing it simply because you own strength and you don't own weakness. It's really that simple. And that is something that you get in my newsletter and in my video updates on a weekly basis. Usually there's probably a couple updates during the week. And if we get into some fast moving times, it can be even be a bit more than that. But back to the signaling versus having a market expert. While I do think that filtering and sorting is not always a bad idea, I want you all to remember that it is very important that you are working with someone that is giving you information that, one, is unbiased. Okay, it's unbiased. I suppose there's always going to be some level of conflict of interest. I guess to some degree, there's always a level of conflict of interest, right? Even with me, if you're being honest, well, is there a conflict of interest with me? I suppose so. I mean, the truth is, I believe in what I'm doing. I know what I'm doing works. And so I want you involved in it. I know that I can improve upon what you're doing, whether you're doing it with a financial advisor, whether you're doing it self-directed. It doesn't matter. The information that I provide you will A, help you reduce risk. B, it will help you establish a disciplined, structured plan to your investing, without a doubt. And C, it is not meant to, although it can be used as a standalone system, it's not meant to be. It's supposed to be part of your overall planning and your overall process. But in that, because I'm so passionate about it, because I'm so certain it works, if I say there's no conflict of interest, that's not true. Because I obviously want you to join in on what I'm doing because I believe in what I'm doing. But what I will tell you is this. I have no vested interest in selling you anything. I have no vested interest in what positions you own. I have no vested interest in any particular company, in any particular sector, in any particular industry. And that is very different than most advisors than anybody that works for a particular company. Even when you're being sponsored and you have sponsorships, this is something that can most definitely influence um, the way you analyze what you're doing. So I had and I'll give you an example right now. One of the greatest investment houses in the world, long term, short term, intermediate term, it doesn't matter, is Goldman Sachs. And I had put out a post recently that talked about Goldman Sachs and their disclaimer that goes on to everything that they put out. And effectively, what their disclaimer said was, look, please be aware that we cover businesses that we hope to do business with. And whether it's like meaningful or not, this isn't a direct quote, by the way, but whether it's meaningful or not, there can be conflict of interest in our analysis here. And the conflict isn't intentional. I mean, I'm telling you that the conflict isn't intentional. That's their disclaimer. They're warning you that there's a conflict, and that's natural. You have to understand something. We're all people. And if something supports you, if something helps you, that creates a conflict for you. Even me, it creates a conflict for even me. Now, I have 20 plus years knowing that what I do works and what I do helps people. So that gives me a level of confidence in telling you that what I'm doing will help you. But the one thing, we are getting back to the conflict of interest, the one thing I can guarantee you is that I'm not working with any businesses, right? I'm not looking to work with any particular business or industry. Therefore, I have no real reason to have a conflict as far as when I say to you. So, for example, I come to you and I say that I wouldn't invest in China. I have no reason to say that to you other than China is in a 20-year downtrend. It's in a 20-year downtrend. If I tell you that I believe right now that metals are being purchased and they are a good buying opportunity, but maybe not at this price level, I'm not telling you that because I'm working with a gold company or a gold IRA company or anything. I am telling you that simply because that's what I see. If I tell you that technology appears to be the trend or the strength, it's because that's what I see. I'm not being supported by any of that. And that's very important when you're evaluating the information that you're receiving. And I hope, and what I always hope, what I consistently try to put out there to people is that you have to do your own analysis to a degree. This idea, don't do your own research, which has become very popular, that used to be known as reading. It's just, that's what research. When you did research, you read. I will tell you, I encourage you to read. Never, ever will I tell you not to compare what I do to what someone else does, or not to read to get a better perspective on what I do. And the reason that I happen to focus on emotions is because I can tell you that the biggest pivoting points in any given market, the biggest pivot points are human emotion. When human emotion shifts from, it doesn't even have to be fear or greed, which is fear of missing out. So if there's a fear of missing out, that's a huge driver to an up market. But it doesn't even have to be anything that substantial. That's a massive, that is a very substantial event when people have a fear of missing out. That event cannot be missed. And let's talk again about one, supporting me. So everyone, there's a QR code here. If you're watching me live, except TikTok, you have a different way to support me. Please do so. If you are interested in receiving unbiased financial opinions and what I'm doing out here today, if this benefits you or you're interested in it, please support me in any way that you possibly can. Some of you that are watching me on LinkedIn or YouTube or Facebook or Twitter, there's a QR code. Please support me. I genuinely appreciate it. It helps me give you the information that I do offer every day out here, and I try to keep it as fair and unbiased as I possibly can. I mean, obviously, I see what I see in markets, but I try to keep it as fair and unbiased as I can. And also, so for those of you just joining, I have a system that I run for folks. It basically offers you the ability to, one, create a disciplined investment approach. a disciplined money management approach, and a disciplined risk management approach. So it all starts with my VIP mentorship program. That's the information. That's where you learn how to set up your risk management. You learn how to set up your cash management, and you learn to set up your investment management. From there, you simply go on to receiving my newsletter on a weekly, bi-weekly basis, where I'll let you know what's going on in markets. I'll let you know if I see big changes coming or what changes I do see coming. I always discuss the strength and the weakness of the market. Strength being things that I believe are good buys at the time, and things that I believe are weakness, so you should stay away from them. How you'll utilize that information is going to be based on you. So some people like to go long only. Long only simply means that you're only interested in buying strength. You're interested in buying things that go up. And then if the market gets risky, you just want to go into a cash position. Other people like to do it by buying what is strong and selling what is weak. So what that means is you're shorting what is weak. So shorting is a way that you are able to make money when something falls. This is what big professional money managers do, and market makers do. What they want to do is they want to be neutral, market neutral at all times. So they are long as much as they are short, which makes them neutral. This is effectively what you're trying to do, is carry zero risk, and you're trying to profit. So you want to carry zero risk and you're trying to profit. There are many different risk management techniques that we go over in the mentorship program. It's right down there in the QR code. If you are on TikTok, just go ahead and message me and I can get you some information on the VIP mentorship program. We go over how to manage your risk. We go over how to set up your investment discipline. We go over how to set up your cash management to make sure that you always have cash available to either buy or sell in a market. Those three pieces are essential to being successful in your investment for the long term. Okay. A lot of people will use me in conjunction with other programs. Maybe they have a financial advisor, maybe they're self-directed, and they're looking to me for information. They want to add to what they're doing. They want to add to understanding what risks are out there. Because back to our conversation of emotions, what I can tell you is that you have two players in the market, and one player is retail, that's average everyday people and their emotions. And then you have the people that run the markets. And these are the people that are going to manipulate your emotions a little bit. Whether it's intentional or not, that's up for you to decide. All I can tell you is this, that when they want prices to go higher, when they want to run prices up, they want to make sure you know about it. They're going to put a very big footprint out there so that you do know about it. They're going to make sure you see that ABC stock is going to the moon, because what they want to do is they want to create a fear of missing out. What you want to do is learn how to identify when they started buying it. Because by the time they want you to know that they've been buying, that's the time that they are looking to sell. That's the time they're getting out of the position by selling it to you. What you need to know how to do is identify it when they start buying it. And that is one of the things that I teach you. I teach you how to identify the people that run these markets when they are starting to purchase, and then when they want you to start to purchase. Because ultimately what you want to do is you want to buy when they're buying and you want to sell when they're selling. And that's exactly what I teach you how to do, is buy when they're buying and sell when they're selling. And the easiest way to identify this is their footprint. How do we identify their footprint? It's pretty simple. Their footprint comes with a lot of trades. When you are one of the big guys in the market, the one thing you can't hide is the number of trades you're placing. You can't hide how big the trade is that you've just made, okay? Conversely, you also can't hide when you start to sell. When you start to sell your large positions, they are identifiable, everyone. It's important to know this. if you can see when someone buys, and okay, so let's take a step back. How do we know when the buying is occurring and when the selling is occurring? Well, that's not all that difficult if you think about it. How do you know when someone's buying? Well, what's the goal? If you are smarter than most and you are the large institutions, how do you know when buying is occurring? Well, they buy low and sell high. So odds are, if you're looking for the purchasing of the bigger players in the market, that will be after a price drop. So it doesn't mean that they had to come out of a bear market. It doesn't mean that price needed to fall 35, 40%, although that's always quite possible. Price could have just fallen 8%, 7%, 5%. 9%. Maybe they're still building their position. But what they will do is leave a big footprint. You can see where they bought. And if a price had dropped, they're never going to buy at highs. Let me help you understand this. Big money, people that operate with a larger account size are not going to buy as a market's rising. They're not going to buy as prices go up and up and up and up and up. They will buy after a down move. They are going to buy after price has fallen. Now, there's several points that you can identify where price falls. I get into that in my mentorship course. That is all part of the system to understand where the buying is occurring, okay? Give me 1 second. Create find to reach invite to join. So I'm sorry, I'm new to the live thing. Someone was asking if they could join the live session, as in jump in on the video, and right now I'm not really ready for that. So there are several inflection points of when buying occurs and when price reversal occurs. They're very common points. I'm probably going to go over those later in another live today. But for now, what you need to remember is they're buying after a price has fallen. So if you see a lot of trading occurring, and I show you how to identify that trading, and prices just fallen 6, 7, 8%, that is most likely institutional purchasing. That is a point at which you will purchase as well. When you are at a high, so the market breaks out, it goes to a new all-time high, and all of a sudden we see a lot of trading, a ton of activity, right? An exorbitant amount of activity, that is most likely selling. And where are they selling from? Wherever that last drop was, and you saw the purchasing. And this is just a regular ebb and flow of the market. You don't need huge recessions, depressions, or even monstrous market corrections for these things to go on. These things go on all the time. And what you want to do is you want to buy when they're buying so that you can sell when they're selling. Again, the system, it's me, Derek Miller. It's my system. My company is Promethean Investing. I am trying to give back the information to you that has been taken from you. I want to help you understand how markets move. I want to help you understand how to avoid bear markets, how to avoid falling prices. I want to help you to buy strength. I want to show you when should you buy, when shouldn't you buy, what to buy. I will help you in my mentorship program. I help you to set up your cash management, set up your risk management, set up your investment management. And then you receive my weekly newsletter, which is usually a bi-weekly newsletter and video update that will tell you exactly what I believe is strong, exactly what I believe is weak, and what I'm doing within my own portfolio so that you can see how the system works. It's an educational tool for you. What you do with the information I provide is up to you. I'm providing it to you so that you have unbiased information with zero conflicts of interest. I don't want there to be any conflict of interest. So I share exactly what I'm doing with you. I share why I'm doing it, how I'm doing it. And after you've gone through the mentorship program, which is 6 weeks long, you will understand it. And then you can use that information in conjunction with your financial advisor, in conjunction with your self-directed trading. You can even use it as a standalone system. It is completely up to you. For now, if you are just joining, listen, I'm going to be live again in a few hours. I will go ahead and post it on all of the social media sources I use when I'm going live. It's going to be probably about 4 p.m. Pacific Daylight Time. So for those of you on the East Coast, that will be about 7 p.m. And if you're other places in the world, you'll have to do the math yourself. I'm not sure where you're at. If you're in London, it's 10 hours in advance. So you're looking at what from 4 p.m. About 2 in the morning. I'd say I'm probably outside of what you're interested in. In any case, thank you so much for joining me. If you have questions, please direct message me. Leave me a comment. I'll get back to you. I want to show you and I want to help you create your own proper investment management system, right? Listen, if you don't have cash management, risk management, and investment management, if you don't have those three pieces that are integral to being successful in managing your assets and your long-term financial goals, if you don't have those things in place, there's no way you can succeed. So again, thank you all so much for tuning in. I appreciate it. I love having you. Please comment, direct message me. I will be live again at 4 p.m. Pacific Daylight Time. That is 7 p.m. Eastern Standard Time. And I will see you then. I'm going to start logging off of all these various live channels. I'll get something put up so that you can make sure that you're here for the live event later today. What we're going to talk about later today is we are going to talk about cash management quite a bit. So I'm going to talk a little bit about how do you manage the cash in your portfolio? What should you do so that you always have cash available? If cash management is not something you've looked at before, it is something you should be looking at. So join me later today and we'll talk about that. Thanks again for tuning in, and I will see you all shortly.